Uber stock is up sharply this year, but here's the uncomfortable truth most investors are ignoring. The market is quietly treating Uber as if it's already outdated, as if driverless cars are just around the corner and Uber's business model is living on borrowed time. And yet, beneath the surface, something very different is happening. Uber's profits are growing, cash flow is accelerating, and valuation is sitting near multi-year lows. So the real question isn't whether Uber is finished. The real question is whether Uber is being mispriced. Stay with me until the end of this video because the final takeaway completely reframes the Tesla versus Uber debate, and it might change how you look at this stock going into 2026. Uber has delivered a strong performance so far in 2025. Even after a recent pullback, the stock remains up roughly 32% year to date. That's not speculation, that's real value creation. I'll be upfront here, Uber is a stock I personally own. But this hasn't been a straight line rally. Uber came into the year with serious momentum and briefly traded above $100 per share. Since then, sentiment shifted. The stock pulled back into the high $70 range, and almost overnight, the narrative flipped. Suddenly, investors weren't talking about execution anymore. They were talking about disruption. They were talking about autonomy. They were talking about Tesla. And whenever fear replaces fundamentals, that's when opportunities tend to form. After the pullback, the same question keeps coming up again and again. What does Uber actually look like heading into 2026, and where could the share price realistically end next year? To answer that properly, we have to strip away the headlines and focus on what truly matters long term: earnings power and valuation. Everything else is noise. According to current analyst estimates, Uber is expected to generate around $4.51 in earnings per share for fiscal year 2027. That number matters because Uber is no longer a story stock. It's no longer burning cash. It's operating as a profitable, scalable platform. Once a company crosses that line into consistent profitability, valuation becomes critical. And that's where things get interesting. Right now, Uber trades at a forward price-to-earnings ratio of about 23.6. On the surface, that might not look cheap until you consider context. This is near the lowest forward multiple Uber has traded at since becoming consistently profitable in 2023. In plain terms, Uber's fundamentals improved, but the stock's valuation didn't follow. When I ran Uber through the discounted cash flow framework, I reached the same conclusion. The stock is priced conservatively relative to its growth, cash generation, and market position. That disconnect is exactly why Uber stood out earlier this year. So let's talk about what the stock could actually be worth. If Uber delivers the expected 451 in earnings per share and the valuation multiple stays exactly where it is today, the stock could reasonably trade around $106 per share by the end of next year. From current levels, that's a return north of 25%, without assuming any improvement in sentiment. That alone is a solid outcome. But here's the key point. I don't believe the valuation multiple stays this low. If the forward PE rises modestly to 26, Uber could move closer to $117 per share. If it expands to 28, the stock could approach $126. And in a more optimistic yet still realistic scenario, a multiple of 30 would imply a price near $135. None of these scenarios require explosive growth. They simply assume the market becomes less pessimistic. So why is Uber discounted in the first place? The short answer is autonomous driving, and more specifically Tesla. There's been a clear pattern over the past year. Whenever Tesla releases news related to self-driving technology, Uber stock tends to react negatively. The market has built a narrative where Tesla dominates future transportation, and Uber becomes the middleman that gets cut out. But here's where the disconnect appears. The excitement around autonomous driving has moved far faster than real-world deployment. Tesla has been testing autonomous vehicles in highly controlled geofenced environments with extensive monitoring and safety constraints. Even recent sightings of so-called driverless Teslas didn't involve paying customers and still relied heavily on behind-the-scenes supervision. This isn't a commercial rollout, it's experimentation. And that's not a criticism, it's simply the reality of how complex autonomy truly is. Every autonomous vehicle currently test and use their technology in the United States uses a combination of LiDAR, radar, and cameras. Tesla's camera-only approach remains unproven at scale. Now here's where Tesla's real advantage comes in. Tesla is exceptionally good at marketing progress. Incremental technical steps are often framed as major breakthroughs, and investors respond accordingly. That storytelling has created a valuation premium that assumes autonomy and robotics will eventually work, even if timelines continue to slip. Those expectations are already fully priced into Tesla stock, but they're also being priced against Uber. If Tesla were on the verge of rolling out fully autonomous, revenue-generating vehicles across multiple cities, Uber would face serious disruption. But that scenario isn't imminent. More likely, 2026 brings incremental progress, expanded testing, continued supervision, and plenty of headlines. That creates ongoing sentiment pressure on Uber, even without meaningful impact on its business. In other words, Uber is dealing with a perception problem, not a performance problem. While the market debates autonomy, Uber keeps executing. Revenue continues to grow at double-digit rates. Profitability is improving. Free cash flow is expanding, and the platform keeps adding tens of millions of active users. At some point, investors are forced to ask a hard question. How long do you discount a company that keeps delivering? Valuation gaps don't close overnight, but they also don't stay open forever. Taking everything into account, I expect Uber's valuation multiple to rise modestly over the next year. Not an explosive move, but enough to reflect improving fundamentals. If the forward PE multiple rises modestly to 26, which is still reasonable for a profitable platform growing revenue and cash flow at double-digit rates, Uber's implied share price moves to roughly $117. If the market becomes a bit more confident and assigns a multiple of 28, the stock approaches 126 per share. And in a more optimistic but not aggressive scenario where Uber trades at a 30 forward PE, the implied valuation reaches approximately $135 per share. Currently, 55 analysts recovering Uber stock. 44 of them has buy rating and 11 with the hold rating. The highest price target for the next 12 months is $150 and the lowest is $78, and the median price target is $110. Taking valuation and analyst expectation, my 12-month price expectation ranges between $110 and $120 per share, with upside potential if sentiment shifts faster than expected. This isn't a hype-driven call. It's a risk-adjusted thesis built on earnings, valuation, and realism. Now I want to hear from you. Do you think the market is right to price Uber as if full autonomy is just around the corner? Or do you believe reality will move far slower than the headlines suggest? Drop your thoughts in the comments. If this breakdown helped, hit the like button and subscribe for more valuation-focused analysis. No hype, no noise. If you stayed until the end, you're already thinking like a long-term investor. This is not a financial advice. Happy investing.